welcome back. We're in conversation also now with Mohammad Hassan, who's also joining us on the show this morning. It's been volatile times, so just to get a sense as well from him on really where we're headed on from here. Mohammad, thanks so much for joining us. We've been taking a look at the kind of FII flows, and they've been encouraging, to say the least, given what we've been seeing lately. Do you see any shift in sentiment? Is it too early to tell, given that we're possibly seeing a plateauing, at least in some of the regions most impacted so far?
First of all, I hope you and your family are all keeping safe during these very challenging times for all of us. Now, with regards to at least what we are seeing on the hedge fund side of things, it's not looking like a very good picture. Although hedge funds have been outperforming underlying markets, but in terms of the flows picture that we are receiving right now, we are tracking around close to 110 billion in AUM decline just for quarter one of 2020. And we are breaking this up into around roughly 70 billion in performance flow, and we are tracking around 40 billion in net capital outflows from the industry. And mind you, these are just preliminary numbers that we have received. The full spate of the numbers is still coming in for March. And our estimate right now is that we'll see the performance-driven losses exceed the 130 billion mark. So if you look at this in the historical context, this is going to be one of the worst 5 quarters for the hedge fund industry in general.
Absolutely. Mohammad, okay, earlier there was some debate on the kind of recovery shape we could possibly anticipate. Are you willing to yet take a call on that, what it could possibly look like, how long it's possibly going to take?
So there's a huge debate around this, and what we have to understand is that right now there's a bit of optimism in the market. We are seeing central banks and governments all around the world easing. Fiscal deficits have been expanded even more. The number of COVID cases in at least on the European side are starting to plateau off. So there's been some good news around that. And then it seems like perhaps the US, Russia, and the Saudi Arabia might kind of reach a deal around oil as well. So all those things are kind of biased sentiment right now, and everybody thinks, okay, it's going to get better on from here. But the thing is that one thing that is here in Singapore as well that we've experienced firsthand is that there is a second wave of this COVID virus that comes, which is being heavily discounted at the moment. And then even apart from that, if we put that aside, and even if we assume that okay, from here on onwards, the whole situation is going to improve, we still have to factor in the fact that there are so many governments around the world that are expanding their deficits to levels which is really going to stretch the economy. So we need to factor in for things like inflation. And then on top of that, we still have a lot of companies with supply chains disrupted globally. It's really going to impact the real economy. There's going to be bankruptcies. There's going to be layoffs. And all these things will take a while before they really, plateau off. Before the economy eventually starts recovering. So from my side, I believe it's going to be a painful recovery. Even the one of the wild cards that regarding to the oil market that everybody's talking about. There's too many unknowns in that as well about the Russians and the US and Saudi Arabia all agreeing to their production cuts, and more importantly from there on even sticking to that. So there's a lot of unknowns. We are seeing that the markets are really frothy and buoyant right now. I think there's going to be a scale back from this, and it's going to be long, drawn-out recovery.
All right. Thanks so much for giving us your views. Mohammad, we'll let you go on that note. Let's also